In January 2025, NVIDIA's stock dropped 17% in a single day. Not because of a scandal, not because of failed products, because a Chinese company released an AI chatbot that cost a fraction of what American companies were spending to build similar technology. $500 billion of market value vanished in hours. That event wasn't the bubble bursting. That was the warning shot. Right now, in early 2026, we're watching the largest speculative mania since the dot-com bubble unfold in real time. And if you understand the 7-stage collapse pattern that destroyed Spain, Britain, and the Soviet Union, you'll recognize exactly where we are. Stage 5, heading into Stage 6, the point where confidence breaks and the entire structure implodes. This isn't speculation. This is pattern recognition. Because empires and economies don't collapse randomly. They follow a sequence: military overextension, currency debasement, debt spirals, loss of productive capacity, social decay, loss of reserve status, then collapse. 7 stages, same order, every time. And the AI bubble is replicating that pattern with terrifying precision. Here's what should keep you awake at night. American companies will spend over $500 billion on AI infrastructure in 2026 and 2027 combined. That's the entire GDP of Singapore. Consumers spend $12 billion annually on AI services. That's Somalia's GDP. We're investing 40 times more than we're earning. The math doesn't work. It never has. And when investment disconnects from revenue this dramatically, you're not building an industry. You're inflating a bubble. Let me show you how we got here and why the next 12 months will determine whether this becomes a correction or a catastrophe. The 7-stage pattern isn't theoretical. It's documented across 500 years of imperial history. Spain controlled half the world's gold and silver in 1590. Within 80 years, they'd declared bankruptcy 4 times and never recovered. Britain ruled a quarter of the Earth's surface in 1914. By 1950, the empire was gone, and the pound had lost reserve currency status. The Soviet Union matched America's military might in 1985. 6 years later, it ceased to exist. 3 superpowers, 3 complete collapses, same sequence every time. Stage 1 is always overextension. The empire stretches beyond its capacity to maintain itself. Spain fought wars on 4 continents simultaneously. Britain defended territory across 6. The USSR tried to match American military spending with an economy 1/5 the size. They all believed their power made them invincible. They were wrong. Stage 2 follows immediately. Currency debasement. When you can't pay your bills through productivity, you devalue the money. Spain mixed copper into silver coins until they contained barely any silver. Britain abandoned the gold standard in 1931. The Soviet ruble became worthless even to Soviet citizens. Every failing power does this. Every single one. Stage 3 is the debt spiral. Borrowing accelerates. Interest payments consume more revenue. Growth stalls. Spain defaulted 4 times in 40 years. Britain emerged from World War II owing more than its entire GDP. The USSR ran out of foreign currency to buy basic goods. The pattern is identical. By stage 4, productive capacity collapses. Spain stopped manufacturing anything. They imported everything and paid with American silver that flowed straight back out. Britain's factories closed. The Industrial Revolution's birthplace became dependent on American loans. The Soviet economy produced nothing the world wanted except oil and weapons. Stage 5 is social decay. Trust evaporates. The best minds leave. Crime explodes. Institutions fail. This is where things accelerate because stage 5 creates the conditions for stage 6. Stage 6 is loss of reserve status or systemic confidence. When allies stop trusting your currency, when trading partners seek alternatives, when the mechanisms that made you powerful become liabilities. Spain's silver stopped being accepted at face value. The pound sterling lost its global role. The ruble was never trusted to begin with. Stage 7 is collapse, not gradual decline, sudden implosion. The Soviet Union went from superpower to non-existent in 900 days. Not from war, from economic failure. Now let's apply this framework to AI. And you'll see we're not approaching the pattern. We're deep inside it. The AI industry has already completed stages 1 through 3 and is showing clear signs of stage 4 and 5. The overextension is obvious. Companies are making infrastructure commitments they cannot possibly sustain. Oracle raised $18 billion in bonds in September 2024, one of the largest tech debt sales in history. Their bonds now trade at junk status, despite the company maintaining investment-grade ratings. They've increased projected capital expenditures from $35 billion to $50 billion for 2026. Revenue isn't growing proportionally. This is overextension. The debt spiral is accelerating. Morgan Stanley estimates that debt funding for AI data centers will exceed $1 trillion by 2028. Meta, Alphabet, and Oracle need to raise $86 billion combined in 2026 alone, just to maintain current spending plans. These aren't investments backed by revenue. These are bets that future demand will justify present spending. When has that ever worked in a bubble? Here's where it gets dangerous. In August 2025, MIT released a study showing that despite $30 to $40 billion in enterprise AI investment, 95% of organizations are getting zero return. Zero. That's not a productivity gap. That's a fundamental disconnect between spending and value creation. The pattern says what comes next. Stage 5 is already visible. Social trust in AI valuations is eroding. Palantir trades at 117 times sales. Revenue grew 104% since 2023. The stock price increased 2,700%. Investor enthusiasm has completely detached from business fundamentals. That's late-stage bubble psychology. And the transition to stage 6 requires only one thing: a trigger that breaks confidence. In January 2025, that trigger appeared. DeepSeek, a Chinese AI model, launched unexpectedly. It matched American models in performance while costing a fraction to develop. NVIDIA's stock dropped 17% in a single day. The assumption underlying trillions in spending, that only massive American infrastructure could produce frontier AI, shattered instantly. Markets recovered, but the crack formed. Confidence wobbled. And once confidence wobbles in a momentum-driven market, the psychology shifts. You're watching investors who know valuations are absurd, but keep buying because everyone else is buying. That's not investing. That's musical chairs. The music hasn't stopped yet, but everyone's eyeing the exits. The Bank of England issued warnings in late 2025. Global market correction risks from overvalued AI firms. OpenAI's valuation tripled from $157 billion in October 2024 to $500 billion a year later. Infrastructure requirements might be impossible to meet. Investors aren't properly cautioned about crash risks. If AI underdelivers, then the International Monetary Fund reinforced those warnings. Kristalina Georgieva, the IMF managing director, drew direct comparisons to the dot-com bubble. A market correction could stunt global growth. Developing economies would suffer most. These aren't fringe analysts. These are the world's primary financial regulatory institutions saying the same thing. The pattern is visible. Jamie Dimon, head of JP Morgan, the largest bank in America, offered the most honest assessment. AI is real, he said, but money will be wasted. Lots of it. He sees higher crash probability in the next 2 years than markets reflect. Then he said something crucial. AI will pay off just like cars paid off, just like television paid off. But most people involved in those industries didn't do well. The technology succeeds. The investors lose everything. That's the historical norm for transformative technology. Railways revolutionized transportation. Railway investors got destroyed. The internet changed civilization. Dot-com investors lost fortunes. AI will reshape everything. That doesn't mean current valuations make sense. Here's the mechanism that connects stage 5 to stage 6. It's not gradual erosion, it's sudden recognition. Markets run on collective belief. Everyone agrees these stocks are worth what they're trading for because everyone agrees. The fundamentals don't support it, but momentum does. Then something breaks that consensus. A bad earnings report. A major customer pulls back spending. A competitor demonstrates you don't need $1 trillion in infrastructure. Suddenly, the collective belief fractures. If everyone's buying because everyone's buying, what happens when everyone starts selling because everyone's selling? You get stage 6, mass liquidation, self-reinforcing collapse. The warning signs are mathematical. American consumers spend $12 billion annually on AI services. Total US AI capital expenditures will exceed $500 billion in 2026 and 2027 combined. That's the annual GDP of Singapore being invested to serve a market the size of Somalia's GDP. The input-output ratio is completely inverted. For this to work, consumer AI spending needs to increase by 4,000%, or enterprise productivity gains need to justify costs that 95% of organizations currently see zero return on. Which scenario seems likely? CoreWeave illustrates the structural fragility perfectly. They're an AI infrastructure middleman. Their customers are Microsoft, Google, Meta. But those customers are also their competitors. CoreWeave exists because hyperscalers can't build data centers fast enough. The moment AI demand growth slows, Microsoft brings those workloads in-house. CoreWeave has a $6.3 billion NVIDIA backstop agreement. That sounds protective until you realize it's a fraction of their exposure. If demand cools even slightly, the business model evaporates. They're not just overvalued, they're structurally dependent on exponential growth continuing forever. Supermicrocomputer, Oklo, Rigetti Computing, D-Wave Quantum. Companies trading at absurd valuations with minimal revenue. Quantum computing plays that haven't produced commercial applications. Small modular reactor specialists years from deployment. They're all priced for perfect execution in markets that don't exist yet. That's not stage 5. That's late-stage speculation where fundamentals have completely disconnected from price. Now consider the financial engineering, circular financing patterns, where AI companies fund each other's growth. Investment firms back company A, which buys services from company B, also backed by the same firms. Revenue gets reported. Valuations increase, but no external value is actually being created. It's just capital moving in circles, creating the illusion of a functioning market. Every bubble has this. Collateralized debt obligations in housing, securitized subprime mortgages, complex instruments that hide the fact there's nothing underneath. AI has the same structures forming right now. The debt profile matches stage 3 perfectly. $1 trillion in data center debt by 2028. $86 billion needed by 3 companies in 2026 alone. Oracle's bonds trade at junk yields despite investment-grade ratings. That's the market saying one thing while credit risk says another. When the spread between official ratings and actual yields diverges like this, it signals that insiders know something public ratings haven't acknowledged yet. Credit markets are warning what equity markets are ignoring. But here's what makes this different from previous bubbles. Speed. The dot-com bubble took years to inflate and burst. Housing took a decade. AI went from niche technology to trillion-dollar infrastructure commitment in 30 months. The acceleration means the collapse, when it comes, won't be gradual. It'll be vicious. Algorithms execute cells faster than humans. Momentum works both directions. The same forces that drove prices up will drive them down harder. Ray Dalio's framework identifies the trigger point precisely. When debt exceeds the capacity to service it, when buyers disappear except central banks, when wealth gaps create instability. AI companies are there. Debt is exploding. Buyers are momentum chasers, not value investors. And the wealth concentration in 5 companies, holding up 30% of the S&P 500, creates systemic fragility. One major failure cascades. So, when does stage 6 actually hit? What's the specific trigger that breaks confidence and starts the cascade? History provides clear answers. DeepSeek already showed us. January 2025. A Chinese AI lab releases a chatbot built for a fraction of American costs. Performs comparably to models requiring billions in infrastructure. NVIDIA drops 17% in one trading day. Not because DeepSeek was better, because it challenged the fundamental assumption justifying every valuation. That massive capital expenditure is necessary for AI advancement. The assumption breaks. Confidence shatters instantly. 17% in hours. That's the trigger mechanism. Not gradual erosion. Sudden realization that the entire premise was wrong. And it doesn't take much. A bad earnings report from a major player. Corporate clients cutting AI budgets after seeing zero returns. Another efficient model proving American infrastructure spending was wasteful. Any of these breaks the spell. Robin Greenwood, who's studied bubble indicators for decades, says, "We're early bubble phase. Valuations look expensive, but not peak insanity yet." The S&P 500 Information Technology Index trades at 30 times forward earnings. High, but nowhere near the 55 times from dot-com peak. Microsoft and Meta are rising, but not exponentially. So maybe there's time. Maybe this stabilizes. Maybe AI delivers the 4.4 trillion in economic value some analysts project. Maybe productivity gains justify the spending. Maybe we're building genuine infrastructure like railroads or electricity networks, not speculative garbage. But those arguments miss the pattern. Early bubble is still bubble. And the transition from early to late happens faster than anyone expects. Dot-com took years. Housing took a decade. AI compressed the entire cycle into 30 months. The acceleration means the back half happens faster too. Momentum works both directions. Algorithms that bought on the way up will sell on the way down. Retail investors piling in because everyone else is piling in will exit the same way. The market isn't driven by fundamentals anymore. It's pure momentum. And momentum reversal is violent. Jamie Dimon acknowledges AI is real, but warns much invested money will be wasted. He's right on both counts. AI will transform industries. Most investors will still lose everything. That's how technological revolutions work. Cars paid off as technology. Most car companies went bankrupt. Television paid off as technology. Most TV manufacturers disappeared. The technology succeeds. The investors fail. Because valuations disconnected from reality don't correct gently. They collapse. Stage 6 isn't about AI failing as technology. It's about AI investments failing as financial instruments. The infrastructure gets built. Some of it proves useful. But the companies that built it at inflated valuations with unsustainable debt don't survive to benefit. CoreWeave becomes a cautionary tale. Palantir's stock crashes 80%, but the company keeps operating. Oracle restructures debt. The hyperscalers absorb the pieces. AI continues developing, just without the speculative excess. But the wealth destruction is catastrophic. Trillions in market cap evaporate. Retail investors who bought at peak lose retirement savings. The 5 companies holding up 30% of the S&P 500 crash. Simultaneously, index funds get devastated. Pension funds take massive hits. This triggers broader contagion. Banks holding AI company debt face losses. Credit markets freeze. Corporate borrowing costs spike. Companies unrelated to AI get caught in the downdraft because everything's connected. Margin calls for selling across all sectors. The correlation goes to 1. That's stage 6, not isolated AI correction. Systemic crisis spreading through interconnected financial structures. Stage 7 is what comes after the rebuilding. Some AI companies survive with realistic valuations. Infrastructure built during the bubble gets repurposed. Genuine applications emerge from the wreckage. AI becomes normal technology instead of speculative mania. But that takes years. The transition from stage 6 to stage 7 isn't quick. Spain took 80 years to become irrelevant. Britain took 40 to lose the empire. Soviet Union collapsed in 900 days, but Russia's still recovering 30 years later. AI's stage 7 might look like .com aftermath. Amazon survived. Pets.com didn't. The technology matured. The speculation died. Took a decade for tech valuations to recover. 15 years before we forgot the lessons and did it again. Because that's the real pattern. Not just the 7 stages of collapse, the cycle itself. Bubbles always return. Different assets, same psychology. Tulips, South Sea Company, railroads, radio, .com, housing, crypto, AI. We never learn because the people living through each bubble believe their bubble is different. Their technology is real. Their valuations are justified. The old rules don't apply. They're always wrong. AI is real technology. The bubble is also real. Both things are true. And when stage 6 hits, when confidence breaks and selling cascades, the distinction won't matter. Real technology with fake valuations crashes just as hard as fake technology with fake valuations. The only question left is timing. Are we 6 months from the trigger? A year? 2 years? The longer it inflates, the harder it crashes. But the pattern says it's coming. 5 stages complete. Stage 6, visible on the horizon. The math doesn't lie. The history doesn't lie. And the companies borrowing trillions to build infrastructure generating minimal returns are running out of time to prove the investment thesis. You're watching it happen in real time. The biggest speculative bubble since housing. Maybe bigger. Definitely faster. And when it goes, it'll take a lot more down with it than anyone's currently pricing in. The pattern has played out 3 times across 500 years. It's playing out again right now. Same stages, same sequence, same inevitable conclusion. This is how bubbles end. Suddenly, violently, and always with everyone claiming they never saw it coming. The 7-stage pattern doesn't predict the future. It describes what's already happening. You don't need forecasting models or complex analysis. You just need to recognize the sequence. Military overextension becomes debt spiral, becomes loss of productive capacity, becomes social decay, becomes loss of confidence, becomes collapse. We're at stage 5, heading into 6. The infrastructure is built. The debt is issued. The valuations are disconnected. The only missing piece is the trigger that breaks collective belief. And January 2025 already showed us what that looks like. 17% in one day. 500 billion in market value gone in hours. That wasn't the collapse. That was the test run. The real version, when it comes, won't recover in a week. It'll cascade through interconnected financial structures until something breaks that can't be fixed with another round of borrowing. Spain took 80 years to fade into irrelevance. Britain took 40 to lose an empire. The Soviet Union took 900 days to cease existing. The AI bubble won't take that long. It's compressed the entire cycle into 30 months of speculation. The unwinding will be proportionally faster. And when it's over, AI will still be here. The technology works. But the companies that spent trillions building infrastructure at unsustainable valuations won't survive to benefit. That's not prediction. That's pattern recognition. And the pattern has never been wrong.